It kind of stinks that the banks really are the precursor to earnings season because it's so hard to draw conclusions from them. Um, we got off to a very good start on the JP Morgan earnings. There was a lot to like in there. I won't belabor it too much. But you saw a nice rise in the stock, and it brought a lot of the other bank stocks up with it, with the exception of Wells Fargo, where the news flow is so negative, and it's really, at this point, become more of a dividend play to many investors than it is a capital appreciation type of play. Um, but and therein lies the problem. Banks are idiosyncratic. Uh, yes, they all essentially have the same input. They borrow money short term and lend it longer term. In the case of the largest banks, there's sort of a too big to fail premium on their savings rates. So effectively, they're borrowing money at zero. So they really can't get any improvement on that because if you have accounts at some of the largest banks, you'll see that they're paying next to nothing on deposits. And so it's how profitably can they lend those out. But the thing is, they all do slightly different things. Bank America, beat in some measures, but then the stock sort of was lackluster afterwards. The problem with Bank America is it's different from the others because they're up against the deposit cap, Chase as well, and they can't grow any way other than organically. They can't buy anybody because basically the controller of the currency says you can't do an acquisition that'll give you more than 10% of the deposit base nationally. So they're kind of frozen into place. JP Morgan's got a better handle on their ancillary businesses, it seems, than Bank America. When I mean that, I'm talking about trading and certain other functions. But in many ways, these banks are so huge. I think it's a real testament to JP Morgan's management team. And not necessarily a knock at Bank America's. I might knock Wells Fargo because a lot of their problems are self-inflicted. But it's very hard to move the needle on these big banks. And the other problem is a lot of them are in very different types of businesses. You saw Bank of New York Mellon sell off fairly hard after their earnings. And the problem is they have a somewhat different mix of business. They're very big in custody and clearing. So they're leveraged the financial markets in ways that some of the other banks aren't. Yes, Bank America does clearing and JP Morgan does, but proportionally, Bank of New York Mellon and State Street are much more, it's got much more of an impact on their bottom line. And then of course now, through the hijinks of 10 years ago, you get Morgan Stanley and Goldman Sachs thrown in with banks, and they're very loosely banks. Yes, they are. Yes, they're banks in a literal sense, but in terms of taking deposits and lending them out to customers, that's really not what they're doing to the same degree. Each of them has small divisions that are getting into that business, but they're far more dependent upon capital markets, and so it just shows that when the good feelings that came out as a result of J.P. Morgan's initial beat don't necessarily translate to the rest of the industry. And I'm going to take that one step further and say the mixed results that you're seeing from the banks are really not a great way to portend what's going to happen in the coming weeks from a wide range of industrial companies. I guess the one thing that we would have been able to take away is had they said wonderful things about loan demand and the economy. I don't think we've seen that on the whole, and that remains that earnings season going forward will probably have its share of surprises.